For most companies, revenue is the single most important measure of success. Yet the accounting rules for measuring revenue have been scattered over years of dispersed guidance to various specific industries. That will soon come to an end, and the accounting professionals must be prepared. We're here today with that shared goal in mind. In May of 2014, the FASB and the IASB issued a final revenue recognition standard, which was the result of a long convergence project. That standard is going to replace substantially all existing revenue guidance, including sector guidance. And there's some specific areas that could differ greatly from current application of GAAP. My name is Dan Amat. I'm joined today by Brian Schilb, and we are going to cover some of those areas of potential impact of the new revenue standard. So the new standard is grounded on a core principle that an entity should recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled. So to achieve that core principle, the standard establishes a 5-step model that an entity would apply. Step 1, identify the contract with a customer. Step 2, identify all the performance obligations within the contract. Step 3, determine the transaction price for the contract. Step 4, allocate the transaction price of the contract to each performance obligation. And then step 5, recognize revenue as each performance obligation is satisfied. So with that backdrop, let's get into some of the provisions of the new standard that represent potential changes to current practice. And I'll hand it over to Brian.
Yeah, thanks, Dan. So as you can see on the screen here, there are a few different things that we're going to talk about that represent potential changes to current practice. First of all, bundled goods and services means that a contract may have various goods and services. And under the new standard, step 2, in identifying the performance obligations, you have to think about whether each of those individual goods and services are distinct. And the standard provides some criteria to determine whether or not those goods and services are distinct. Second of all, with significant financing component, this is part of step 3 in determining the transaction price. The objective here is to recognize revenue based on the cash selling price that would have been used if the customer had paid the entity when the good or service was transferred. The interest rate that's used here is based on the entity that's receiving the financing. So in some cases, if it's an advance payment from the customer, the entity is receiving the financing. But if the customer is paying in arrears, then the customer is receiving the financing. If the customer is paying in arrears, you would generally discount, assuming you had to apply the significant financing component, you'd have to discount the revenue, versus if it was an advance payment, the entity would have to start recording interest expense and a corresponding increase in the contract liability, and ultimately would recognize more revenue than cash received. There are also some conditions laid out in the standard for when an entity would not adjust its transaction price for a significant financing component. But the last point I wanted to make here is that there's a practical expedient in the standard that says if the difference in timing between payment and performance is 1 year or less, then you're not required to adjust the transaction price for a significant financing component.
So Brian, let's go back quickly to the point you mentioned about conditions where you might not apply this guidance of significant financing component. What if I'm in the construction industry and my customer is keeping back a retainage amount till they're satisfied with the end product? Does that, say, 10% retainage represent a significant financing component if I'm in a multi-year situation?
Yeah, that's a good question. And as I mentioned, there's some conditions in the standard that would indicate that the payment terms are structured for reasons other than financing. And in the standard, they give an example of retainage in the construction industry as an example of that one of those situations. I do not think that an entity in the construction industry would be required to adjust the retainage or adjust their transaction price for retainage. So moving on, variable consideration. This is broadly defined now, and it could include things like rebates, refund, bonuses, penalties, royalties, rights of return, really anything that could cause the transaction price to change. And there's some guidance in the standard on estimating and constraining the variable consideration. A couple of points I wanted to make here. First of all, estimating and constraining is not necessarily a two-step process. So you're supposed to include the amount of variable consideration in your transaction price up to the amount that's probable of not resulting in a significant revenue reversal. A key point here is it's up to that amount. So there's some minimum amount that's going to be probable of not resulting in a significant revenue reversal. Under the multiple element arrangement guidance that we have today, there's something known as the contingent revenue cap. And this is something that requires the amount that limits the amount allocable to the delivered item to the amount that's not contingent upon delivering subsequent items. Now, under the new standard, that contingent revenue cap will be eliminated, and you'll not be required to consider that when you're going through your allocation in step 4.
So, Brian, let me stop you there. This seems like it could be a sensitive area for, say, the telecom industry. Talk a little bit about how this would play itself out for a telecom selling a phone and service.
Yeah, so today under existing GAAP, this contingent revenue cap would basically allow a telecom company to recognize revenue as it bills its customers for the services. So because let's say a company gives its customer a free phone, the consideration that it would receive for that phone is all contingent upon the future services. And because that contingent cash cap has been removed, now companies will be required to determine what is the standalone selling price for both the phone and the services and do an allocation based on a relative standalone selling price basis. Okay, so let's move on to the estimated selling price. Basically, allocation, you're going to use a relative standalone selling price as a general rule of thumb. There are some exceptions to that. We are able to allocate variable consideration or a discount to a particular performance obligation or distinct good or service. Also, the residual approach is permitted in certain circumstances, but I wanted to make a key point. We're talking about estimating the standalone selling price for purposes of allocation. So when you're determining your standalone selling price, first of all, the residual approach is only going to be able to be used when the price of that good or service is highly variable or uncertain, and the other goods and services have an observable selling price. With respect to the timing of revenue recognition, Step 5 introduces a new concept of determining whether or not a performance obligation is satisfied over time. It gives 3 criteria for making this determination, and if any one of the criteria are met, then you recognize a revenue for that performance obligation over time. The first one is that the customer simultaneously receives and consumes the benefits provided by the entity's performance as that entity performs. So think of a typical, standard service contract like a cleaning contract or electricity being provided. The second criteria would be that the entity's performance creates or enhances an asset that the customer controls as that asset is created or enhanced. For example, think of a construction contract where the customer owns the land on which the building is being constructed, and at any time the customer could replace that contractor. Because the customer controls the WIP, the performance obligation is being satisfied over time. And the third overtime criteria has 2 parts. First, the entity's performance does not create an asset with an alternative use. And second of all, the entity has an enforceable right to payment for performance completed to date. In terms of evaluating alternative use, you have to think about practical or contractual limitations. And for the second component, with respect to an enforceable right to payment for performance completed to date, you're thinking about, if the customer canceled the contract, say, halfway through, would the entity be entitled to payment for not only its costs, but also a reasonable profit margin? If none of these criteria are met, then the performance obligation is satisfied at a point in time, and the standard provides some indicators for performance obligation being satisfied at a point in time. Moving on to software arrangements, today there's a requirement to have VSOE, or vendor-specific objective evidence. That's no longer going to be required for those delivered items. Licenses, there's some implementation guidance for licenses, and the key question here is if I have a license of intellectual property, is the performance obligation associated with that transferred or satisfied at a point in time or over time? And there's some specific criteria that let you know whether or not it's satisfied over time. There's been a lot of debate about the application of those. Contract costs, there's specific guidance in there on cost to obtain a contract with the customer, and also cost to fulfill a contract with a customer that could result in some changes in practice. Construction type contracts, today a lot of construction contractors are applying 81.1. The new standard is going to decouple the contract revenue and contract costs. it's going to be possible to maintain a consistent margin, usually only if a company applies cost to cost as its measure of progress. And again, that's not a required measure of progress, but that's going to be the best one to be used for maintaining a consistent margin. There's really going to be no basis left for capitalizing contract costs. Generally, the contract costs are going to be expensed as incurred. If you determine that your performance obligation is satisfied over time, generally not going to have any WIP or finished goods on your balance sheet. With respect to real estate, we apply today FAS 66, and it has very specific guidance for having a sufficient initial and continuing investment, and an entity is not allowed to have continuing involvement if it wants to recognize kind of the full accrual of the profit, and that guidance has been eliminated. So under the new standard, companies will have to determine, first of all, whether collectability is probable, and second of all, whether control has transferred.
So, Brian, we touched pretty briefly on the construction and real estate guidance. Where can we go if we want to get into some more detail on those industries?
Yeah, that's a good question. I mean, this is more of a general podcast. We actually have some separate podcasts recorded for both construction-type contracts and real estate, so I'd encourage the listeners to go out and find those podcasts for more detailed information.
Okay, fantastic. So lastly, let's talk about effective date and transition. For public business entities and certain nonprofits, the effective date will be for fiscal years starting after 12/15/2016. So if you're a calendar year company, it's going to be effective starting January 1st, 2017, and then interim periods within that year. All other entities will basically have a 1-year deferral, and for public business entities, there is no early adoption allowed. Preparers will have 3 choices when it comes to transition. First is full retrospective approach, so all periods presented will be restated. There are some practical expedients that are available to apply to the retrospective approach, one of those being the use of hindsight for any variable consideration that is getting restated in prior years. And then the last option is cumulative effect at the date of adoption. In this scenario, your 2017 financials are presented under the new standard, and then any contracts that were opened before 1/1/17, if you're a calendar year company, you would apply the standard retrospectively, and that adjustment between what revenue had been recorded before and revenue as the new standard would have it is recorded as a catch-up adjustment through retained earnings. So thank you for joining us today. If you'd like additional information, you can always refer to KPMG's Financial Reporting Network, which has got the latest on revenue recognition and links to KPMG analysis of the new standard. Some examples of that would be our defining issues, our webcasts, and other podcasts that Brian mentioned before.